Welcome to the Trestlebridge Capital Market Observations Call for the week of December the 5th, 2022. I'm your host, Eric Jefferson. Before we get started here, I have a few quick words from our legal team. And with that, can dive in. I want to start by congratulating the U.S. men's soccer team on the World Cup run. Unfortunately, came to an abrupt end over the weekend as they faced Netherlands, but great to see the national response and support of that team. As we look at last week, another busy week, had a lot of volatility, a big update on Wednesday following some dovish comments from Powell, who suggested future rate hikes may not be as severe as many had expected. We also saw for the first time ever, he acknowledged the risk of doing too much, of raising interest rates too high to the point that would have an adverse impact on the economy. That in many ways was interpreted as an official pause, if you will. Not surprising, saw a rally in both stocks and bonds leading up to that, although I'm still somewhat skeptical that a full pivot is now imminently around the corner. That is something the market is currently pricing in, and my struggle to get behind that idea is largely due to the hotter than expected jobs report we got on Friday. That suggested that wage growth, which long-term is highly correlated with inflation, continues to move higher. That is great for workers and for labor. Unfortunately, for Powell, that means he has more work to do to get inflation down longer term. All in all, though, market was up about 1% last week. For the first time since April, it eclipsed the 200-day simple moving average. It's actually a big technical indicator. As well, the month of November up over 5.5%, again, which has been part of a near double-digit rally here over the last month and a half, 2 months. Last week, we also saw the U.S. dollar trade to its lowest level since June. That in turn has helped spark a rally both globally, especially in Europe. Part of the reason there, large U.S. companies that generate revenue overseas then take a hit when they translate those revenue dollars back to the U.S. balance sheets. As well, for any countries that trade with the U.S., a stronger dollar means they have to pay more for our goods, or the goods we buy from them are now cheaper. All in all, not surprisingly, particularly in Europe, seeing that positive impact following a declining dollar. Additionally, there, having a warmer than expected winter has been a huge tailwind. Majority of the energy for Europe comes from Russia. And this morning we saw a $60 a barrel price cap go live. The concern there is obviously, where does energy come from? Particularly if you have a cold winter, you need energy, natural gas and oil to be able to keep your citizens warm, as well to be able to run your economy. So in enjoying a not as bad as expected winter, at least thus far, certainly been a catalyst for Europe, which has had quite the run here the last several weeks. We also saw on the domestic front, personal savings rates trading to or ticking down to near all-time lows. It's actually a theme that I don't believe got enough coverage in the media. We've talked time and time again about the importance of the U.S. consumer. They make up about 70% of our economy. Thus far, they have been incredibly resilient in the face of higher prices, have continued to go out and to spend. The concern, though, is at some point when those savings run out, they now need to adjust their lifestyle or put everything on a credit card. One of the leading indicators of excess savings being depleted is the savings rate at its lowest level. So clearly a leading indicator that may see some consumer behavioral change going forward. Something, given how important a role it plays, we'll certainly continue to monitor it very, very closely. As we take a step back from sort of a macro standpoint, not surprised in the recent rally that we've had in both stocks and bonds. That was following the Fed pause that we've talked about. However, in my opinion, it seems that there's a little too much optimism out there at this point. And as a result, I've used the recent rally here to actually take some gains, take a few chips off the table, and tilt towards a more defensive, more conservative positioning. We had actually went 100% back in the October lows. That was something really just viewed as an opportunity to be fairly prudent here, take some gains as we reposition for what the road ahead may look like. As always, more than happy to discuss our current trades, positioning, or outlook ahead in more detail. If we don't connect, though, have a great rest of the week. Take care.